Welcome to the Deep Dive. Today we're taking a deep dive into the exciting world of volatility trading. We're going to be looking at how to understand and measure volatility, forecast volatility, and make money by trading volatility. And also we'll be talking about the crucial role that psychology plays in this type of trading.
Volatility trading focuses on the expected range of an asset's price movements rather than simply trying to predict whether a price will go up or down.
Right. And for this deep dive, we're going to be using a fantastic resource that you, our listener, brought to our attention, which is the second edition of Volatility Trading by Euan Sinclair.
Yes, this book is a great guide for anyone who wants to learn more about volatility trading. It covers everything from the basics of volatility to more advanced concepts like hedging and money management. The focus of this book is on positional volatility trading.
Positional volatility trading is a style of trading where trades are held for a longer period of time, typically for days, weeks, or even months.
That's right. It's different from high-frequency trading, where trades are held for very short periods of time, often only seconds or milliseconds.
So our mission today is to try to unpack the core ideas of this book. And we'll touch upon some of the psychological aspects of trading volatility as well. And again, this was a listener suggestion, so thank you so much for sending this our way.
Yes, thank you.
So let's jump into it. So Sinclair starts off the book by emphasizing the importance of having a trading philosophy.
He compares trading to other endeavors like value investing or growth investing and argues that just as it's important to have a philosophy in those areas, it's also important to have a philosophy when it comes to trading volatility.
Yeah, I think that makes a lot of sense. A lot of people, especially when they're newer to trading, they just kind of jump into it without really thinking about what their goals are, what their approach is going to be.
Right. And I think that can lead to a lot of problems down the road because if you don't have a clear understanding of why you're trading and what you're trying to achieve, it's going to be very difficult to stay consistent and to make good decisions when the market is moving against you.
Now, Sinclair also addresses the skepticism that some traditional traders have towards quantitative or statistical techniques.
A lot of traditional traders might rely more on intuition or gut feeling and might be hesitant to embrace more data-driven approaches. But as Sinclair points out, this type of thinking is similar to how baseball was for a long time, where there was a reluctance to use statistics to analyze player performance. But now, of course, baseball is very much a data-driven sport.
Yeah, I think in a lot of fields there's this kind of tension between the old guard and the new guard, right? And the people who've been doing things a certain way for a long time are sometimes resistant to change, but, the world is changing. The market's always changing. And the traders who are able to adapt and embrace new ideas are the ones who are going to be most successful.
Well, what's really interesting is that many of these same traders who might be hesitant to use more quantitative approaches to, say, forecasting volatility, they're perfectly comfortable using the BSM model.
The Black School's Merton model, right?
Yeah, and talking about implied volatility and things like that. So it's not like they're opposed to math or to using models. It's more that there's maybe a resistance to change or to the idea that their existing skills might become less relevant.
Yeah, it might be threatening to their sense of identity as a trader, right? If they've always prided themselves on being able to read the market and make good trades based on their intuition, it can be hard to accept that there might be a more systematic or data-driven way to do it. And Sinclair's pretty direct in saying that their concerns might be valid.
Yeah, and I think he makes a really good point when he argues that the market thinks in Black School's terms. So even if your strategy is based on identifying opportunities where the market is mispricing volatility, you still need to understand how the BSM model works.
Right? You need to know what the market's expectations are in order to be able to identify situations where those expectations are wrong. So it's like having a solid graph of grammar before you try to write a novel.
Right. You need to understand the rules before you can break them effectively.
So we've got this kind of trading philosophy as our foundation.
Yeah.
Now let's get into how do we measure this thing called volatility? Right off the bat, the book makes it clear that volatility is not something you can just point to.
Right. It's not something that's directly measurable. You can't just take a snapshot of it. Volatility is a measure of how much prices have fluctuated over a period of time.
So we're always in the realm of estimation.
Yeah, we're always trying to estimate what the true underlying volatility of an asset is.
And the book lays out several different ways to estimate volatility, each with their own strengths and weaknesses. Let's start with the most basic one, close-to-close volatility.
Close-to-close volatility is simply the standard deviation of the daily returns of an asset over a chosen period of time. So, for example, if you want to calculate the close-to-close volatility of a stock over the past 30 days, you would take the daily closing prices for the past 30 days, calculate the daily returns, and then calculate the standard deviation of those returns.
Okay, but what's the drawback of using this method? The book uses the word inefficient.
Yeah, it's inefficient because it only uses one data point per day, which is the closing price, and it completely ignores all the price movements that happen during the day. So if you have a stock that's very volatile during the day but tends to close near its opening price, the close-to-close volatility might be understating the true volatility.
And it can also be distorted by things like dividends and stock splits if you don't adjust the historical price data.
Yeah, if a stock price drops because it's going ex-dividend, that might look like a period of high volatility when it's really just an accounting adjustment. So you need to adjust for those things if you're going to use close-to-close volatility. And one way to do that is to simply subtract the dividend amount from all the stock prices before the ex-dividend date. But that can create some problems.
What kind of problems?
Well, if you have a long history of dividends, you can end up with negative prices.
That doesn't really make sense, does it?
Right. So Sinclair says a more robust approach is to use a backward adjustment factor. So what you do is you multiply all the prices before the ex-dividend date by a factor that preserves the percentage changes in price.
So you're basically just shifting the entire price history down by a certain amount.
Right. And that way you maintain a consistent historical price series for volatility calculations.
So close-to-close volatility is a starting point,
Yeah.
but it has its limitations. What's another method that we can use?
The next estimator Sinclair introduces is the Parkinson estimator.
Parkinson estimator. Okay.
And this one looks at the daily range of the asset price, the highest price, and the lowest price reached during each trading day.
So instead of just using one data point, it's using 2 data points per day.
Right. And the idea is that this should give us a more efficient estimate of volatility because we're incorporating more information. And Sinclair mentions that in simulations using artificially generated data that follows a specific statistical process called geometric Brownian motion, the Parkinson estimator actually does outperform the close-to-close method in terms of efficiency.
So it converges to the true volatility faster.
Yeah.
But does it have any downsides?
Yeah. The main downside is that it still only uses 2 data points per day. It doesn't look at the opening or closing prices or any of the price action that happens within that high-low range.
Okay, so it's capturing more of the price movement than close-to-close, but it's still not the whole picture.
Right.
So what's the next step?
Well, the next step is to try to incorporate even more of the available price information. And one way to do that is to use the Garmin class estimator.
Garmin class.
Yeah, and this estimator not only uses the daily high and low, but it also uses the opening and closing prices.
Okay, so it's taking into account more of the nuances of the price action throughout the day.
Right, and under certain conditions, like if there aren't any big price jumps between the close and the open of the next day, Garmin class can be even more efficient than Parkinson.
But even Garmin class doesn't capture everything, right?
No, there's always going to be some information that's left out, and that's why there's no single perfect estimator. The best estimator is going to depend on the specific asset you're trading and your trading objectives.
Right. And there are other estimators as well. Sinclair discusses the Rogers-Satchel estimator,
Yeah.
which tries to be less affected by price jumps. And he also briefly mentions even more sophisticated techniques, like estimators based on the first exit time.
Right, which is how long it takes for the price to reach a certain level. And he also talks about estimators based on the central limit theorem.
Okay, so there are many different tools in the toolkit. What's the key takeaway from this section of the book about measuring volatility?
Well, as I said, there's no single best volatility estimator, so you need to make informed choices about which estimator to use. You need to understand the strengths and weaknesses of each method.
And then the next part of the book shifts gears to the idea of how volatility actually behaves in the real world.
Right, and we move from measuring volatility to understanding some of the general statistical properties of asset prices.
And he uses the concept of stylized facts.
Right, and Sinclair emphasizes that these are just general tendencies. They might not be true in every single case, but they are common patterns that we see across many different markets.
Because these are things that we can kind of reasonably expect to see.
Right.
And one of the major stylized facts is the autocorrelation of absolute returns, which is often referred to as volatility clustering.
Right, and volatility clustering means that volatility tends to be persistent. So if volatility is high today, it's more likely to be high tomorrow as well. And if it's low today, it's more likely to be low tomorrow. And this is true even if the underlying price movements don't have a strong day-to-day relationship.
So it's not just a random walk. There's actually some kind of structure or pattern to volatility.
Yeah.
Now, the book mentions some interesting nuances to this clustering effect.
Yeah, it tends to be more pronounced in developed markets compared to emerging markets, and it's stronger during bear markets than during bull markets. But the persistence of volatility actually decays faster during bear markets.
So high volatility tends to stick around, but in really turbulent times, it could be shorter lived.
Yeah,
And then another key stylized fact is mean reversion,
right.
which means that while volatility does tend to cluster in the short term, it doesn't just keep rising or falling forever.
Right, it tends to revert back to some long-term average level. And Sinclair actually mentions a specific statistical test.
What's that?
The variance ratio test, which you can use to formally test for this mean reverting behavior. And we see evidence of this in things like the VIX, where if you calculate volatility from, say, daily returns,
Yeah.
it's typically higher than the volatility that you would imply from, say, monthly returns. So that suggests that there is this pullback to a central tendency.
Yeah. We've seen the VIX spike up dramatically during times of market stress
Right.
and then gradually decline over time.
Yeah.
So it's not just random noise. There's this equilibrium level that volatility kind of gravitates back to.
Yeah.
Okay, so we've got clustering, we've got mean reversion.
Yeah.
What else is there to know about how volatility behaves?
Well, the book also discusses the characteristics of the return distributions themselves.
Okay.
And it turns out that they don't follow a nice, neat, normal distribution.
Which is what a lot of people kind of expect.
Yeah, a lot of the basic statistical models that people learn about assume that returns are normally distributed. But in reality, asset returns tend to be skewed. They tend to have what are called fat tails, which means that extreme price movements, both positive and negative, occur much more often than a normal distribution would suggest.
So those black swan events, those big, unexpected price swings,
Right.
they're actually more likely than we might think.
Yeah. And this is not a recent discovery. This has been observed for a long time. And for stocks, a lot of the fat tails, that measure of the fatness of the tails, actually comes from the overnight returns. So the price changes that happen between the market close and the next day's open.
That's interesting. I would have thought that most of the big price moves would happen during trading hours.
Yeah, it's kind of counterintuitive, but it just highlights the importance of those overnight periods when news and information can accumulate and then get priced into the market at the next opening.
So now the next question is, how predictable is all of this?
Right.
Because if we can predict volatility, then obviously there's a lot of potential for profit there.
Right. And the traditional academic view is that it's very difficult, if not impossible, to consistently predict the direction of asset prices.
Right, because the market's efficient.
Right. If there were predictable patterns, then traders would exploit them until those patterns disappeared. But Sinclair poses a thought-provoking question, which is, why wouldn't the same logic apply to volatility? If volatility were predictable, then wouldn't traders just arbitrage it away?
Yeah, that's a good point.
But Sinclair argues that while predicting the direction of price might be really hard, volatility seems to exhibit more predictable patterns. We just talked about volatility clustering and mean reversion, and he suggests that options markets might be inefficient enough to allow for profitable trading based on volatility expectations. He mentions that there's differing opinions among traders about how news will impact volatility, and that there are certain individuals and firms that have demonstrated consistent profitability in options trading.
So there's this potential for an edge,
Yeah.
at least in the volatility space. Okay.
Yeah.
Now the book gets into how to forecast volatility. It starts with some simple forecasting methods like moving window forecasts and exponentially weighted moving averages.
Right. So these methods essentially look at historical volatility to predict future volatility.
Yeah, which makes sense.
Yeah. So a moving window forecast would be something like, if you want to predict volatility over the next 20 days, you'd calculate the average volatility over the past 20 days and use that as your prediction.
Yeah. And EWNA puts more weight on the more recent data.
Right. So it's more responsive to recent changes in volatility.
So both of those are pretty straightforward, but the book mentions that there's a key limitation with EWMA. What's that?
EWMA ignores mean reversion, so it essentially assumes that the current level of volatility is the best predictor of future volatility, but we know that volatility tends to revert to its long-term average, so EWMA doesn't really account for that.
Okay, and that's where the Garch family of models comes in.
Right. The Garch models explicitly account for mean reversion, and they do this by incorporating a long-term average variance into their forecasting mechanism.
And what's really neat about the Garch models is that they can generate a term structure of volatility forecasts. So it's not just a single point estimate. It's a curve that shows how expected volatility changes over different horizons. The book even shows an example of this.
Yeah, for Microsoft, it shows how a GARCH model might predict that volatility is going to be higher in the near term and then gradually decline over time to that long-term average level.
So you get a much richer picture of the future, but even the GARCH models aren't perfect, right?
No, they're not. Sinclair mentions that they often tend to produce these smooth term structures that might not capture the more complex shapes that we sometimes see in the implied volatility surface. So, like if you plot the implied volatility for options expiring in different months, you might see these humps or inversions where the volatility is higher for options expiring in, say, 2 months than it is for options expiring in 1 month or 3 months.
And that suggests that the market's expectations aren't always perfectly captured by a GARCH model.
Right.
Now, when you're using models like GARCH, you have to determine the specific values of the parameters within the model.
Yeah.
And the book talked about a method called maximum likelihood estimation.
Yeah, MLE is a statistical technique that you can use to find the parameter values that would make the observed historical data most likely,
Okay.
given that the model is a good description of the data.
And the book also mentions that there's this potential criticism that MLE can sometimes be seen as retrospective curve fitting, meaning that you're just kind of tweaking the model to fit the past data.
Yeah, that's right. But Sinclair also says that this is more of a potential issue with how the model is applied rather than a fundamental flaw in the model itself.
Yeah. I think it's important to keep in mind that with any model, you're always making assumptions, and those assumptions might not always be perfectly valid, and it's really important to understand the limitations of your models.
Right.
So these GARCH models are a powerful tool, but they're not, foolproof crystal balls.
Yeah.
And then the book introduces another way to think about future volatility, which is the volatility cone.
Yeah, and the volatility cone is really helpful because it gives us a visual representation of the range of historical volatility. So instead of just getting a single point forecast from a model like GARCH, we can see the whole distribution of what volatility has been in the past for similar time periods.
So how's it constructed?
Well, you basically look back at a long history of data, let's say, 10 years of daily data, and you calculate the realized volatility over different horizons. So maybe you calculate the volatility over the last 20 days and the last 40 days and the last 60 days and so on. And then you plot the distribution of those historical volatility levels.
Okay, and what does that tell us?
Well, it tells us what the maximum, minimum, and median volatility has been historically for those different horizons. And it also tells us what the 25th and 75th percentile volatilities have been. So it gives us a really good sense of the range of possible outcomes.
So instead of just getting a single point estimate from a model, you get this richer picture.
Yeah. And Sinclair argues that for trading purposes, it's often more informative to compare the current implied volatility, the volatility that's priced into options, to this historical distribution from the volatility cone.
Yeah, so you can see where implied volatility fits relative to its historical range.
Right, and that can give you a better sense of whether the market's expectations are too high or too low.
Yeah, that makes a lot of sense. Now, the book also touches on the idea of using fundamental information to forecast volatility. What does that mean?
Well, so far we've been talking about forecasting volatility based on historical price data, but you can also look at fundamental information about the underlying asset to try to get a sense of its future volatility.
So, for example, if you're trading a stock, you might look at the company's financial statements.
Right. You might look at things like their earnings volatility or their debt to equity ratio or the volatility of their cash flows. And Sinclair cites some research that has shown that there are certain fundamental characteristics that are associated with the market underestimating or overestimating future volatility.
Okay, so if you can identify those characteristics, you might be able to find some trading opportunity.
Right.
But there are also limitations to relying on fundamental information, right?
Yeah. And Sinclair mentions that it's generally more useful for longer-term forecasts and for comparing the relative volatility of different assets rather than for getting a precise short-term forecast.
So it's a good tool to have in your toolkit, but it's not a silver bullet.
Yeah.
Now, another important point that the book makes is that you shouldn't just blindly rely on historical data, whether it's historical price data or historical fundamental data.
Yeah, that's right, because past performance is not necessarily indicative of future results.
Right, especially in the financial markets where things are always changing.
Yeah, and Sinclair points out that historical data can't account for unprecedented events. Those unknown unknowns that can really throw a wrench into things. And he also talks about how the very structure of the market can introduce biases. Like, for instance, market makers often tend to, quote, implied volatilities slightly higher than their actual expectation of future realized volatility. And that's because they're trying to protect themselves from adverse move and to profit from the bid-ask spread.
So there's this kind of built-in upward bias in implied volatility,
Yeah,
which you need to take into account.
yeah.
Now, the book introduces a way to kind of adjust implied volatility to try to get a sense of the true, like, real-world physical volatility.
Yeah.
What's that about?
You can take the implied variance and adjust it for the skewness and kurtosis of the underlying asset's return distribution. So those are the measures of asymmetry and tail heaviness that we talked about earlier.
Okay.
And you can also adjust for the assumed level of risk aversion among market participants.
So you're basically taking into account all these extra factors that the standard Black Scholes model doesn't really consider.
Right, and this adjusted volatility might give you a more accurate view of what the fair volatility should be, and that can help you to identify specific options or option spreads that might be mispriced.
Okay, so to conclude this section on forecasting volatility, what's the big picture takeaway?
The big takeaway is that all trading inherently involves prediction. Even if you're not explicitly using a model, you're still making predictions about the future.
Right.
And given that volatility seems to be more predictable than the direction of price itself, it makes sense to put some effort into trying to forecast volatility.
Yeah. And there are tools and techniques that you can use to do that.
Right.
Okay, so now let's move on to implied volatility.
Okay.
The book explores how implied volatility behaves, what influences it, and how we can trade it. So what are some of the key things to understand about implied volatility?
One of the most important benchmarks for understanding overall implied volatility is the VIX index, which the book actually includes a historic chart of.
Yeah.
And the VIX is basically a measure of the market's expectation of the annualized volatility of the S&P 500 index over the next 30 days. And it's derived from the prices of a wide range of options on the S&P 500.
So it's kind of a forward-looking measure of volatility.
Right.
But when we're trading, we're not really trading the VIX itself.
No, we're trading the implied volatility of individual options
Right.
on specific assets.
Now, the book gets into some trading strategies that revolve around events that are known to cause moves in implied volatility, things like earnings announcements.
Yeah, one common strategy is the long straddle,
Okay.
which is where you buy both a call and a put option on the same underlying asset
Yeah.
with the same strike price and expiration date.
And you're doing this just before the earnings announcement?
Yeah, and the idea is that the increased uncertainty around the earnings release will cause implied volatility to rise.
Right. Because nobody knows what's going to happen.
Right, and then the subsequent price movement, regardless of whether the stock goes up or down, should be large enough to make at least one of the options profitable.
Okay, so you're basically betting on a big move in either direction.
Yeah, and Sinclair actually presents some research that shows that this strategy has been profitable in the past. He looked at a portfolio of large-cap stocks over a multi-year period and found that the long straddle strategy was profitable even after accounting for the transaction costs of trading options.
But isn't there also the opposite strategy where you sell the straddle?
Yeah, the short straddle is where you sell both a call and a put option.
And you're betting that the price won't move very much.
Right.
And that implied volatility will decline after earnings announcement.
Yeah, and you would talk that the short straddle would be profitable when the long straddle is not profitable. But interestingly, Sinclair finds that that's not always the case. In fact, he finds that both the long straddle and the short straddle can be profitable if you trade them in the right situations. And one of the key factors that he identifies is analyst dispersion.
Okay, what's that?
Analyst dispersion is basically a measure of how much disagreement there is among analysts about a company's future earnings.
Okay.
So if there's a lot of disagreement, that means that the market is uncertain about what's going to happen. And that uncertainty can lead to higher implied volatility.
Which creates opportunities for both buyers and sellers of volatility.
Yeah, so if you can identify situations where analyst dispersion is high, you might be able to find some profitable trades.
Now, the book also talks about how implied volatility moves in relation to the price of the underlying asset. And it mentions these concepts called sticky strike and sticky delta.
Right, sticky strike and sticky delta are essentially rules of thumb that describe how implied volatility often behaves as the underlying asset price changes. So sticky strike says that the implied volatility for a specific option strike price tends to stay relatively constant even when the underlying price moves.
Okay.
And sticky delta says that the implied volatility of an option with a particular delta, which is its sensitivity to changes in the underlying price, tends to stay relatively constant as well.
So it's like implied volatility is kind of stuck to the strike price or to the delta.
Yeah, and Sinclair points out that these rule of thumb can sometimes break down, and when they do, it can create opportunities for arbitrage.
Okay, so it's good to be aware of these rules, but also to be aware that they're not ironclad laws.
Yeah.
Now, what about the volatility smile?
Right.
This is something we new traders talk about all the time.
Yeah, the volatility smile is basically the pattern that you see when you plot implied volatilities against strike prices for options with the same expiration date. So for equity options, you usually see that options that are further out of the money have higher implied volatilities than options that are closer to the money.
Okay, so the smile is kind of like a U shape.
Yeah, or a smirk.
And why do we see this smile?
Well, there are a lot of different theories, but one of the most common ones is that it's a reflection of market participants' fear of large price moves. So they're willing to pay more for options that will protect them from those moves.
Okay, so that's why the out-of-the-money put options tend to have higher implied volatility.
Right, because those options are more likely to pay off if there's a big move to the downside.
Now, the book also mentions that you can actually trade the volatility smile.
Yeah.
What does that mean?
Well, it means that you can try to profit from changes in the shape of the smile. So, for example, if you think that the smile is going to get steeper, you might buy out of the money options and sell at the money options.
Okay, so you're basically betting on the wings of the smile getting higher.
Right.
And is that a profitable strategy?
Well, it can be, but it's definitely a more advanced strategy,
Right.
and it requires a lot of skill and experience.
Now, Sinclair also talks about how you can try to extend the Black Scholes model to better understand the volatility smile.
Yeah, the standard Black-Scholes model assumes that returns are normally distributed,
Right.
but we know that that's not true in reality. So people have tried to come up with models that incorporate the skewness and kurtosis of the return distribution into the Black-Scholes framework.
And what's the goal of doing that?
Well, the goal is to try to come up with a more accurate model that can better explain the volatility spile.
Okay. And has anyone been successful?
Well, there have been some promising models developed, but it's still an area of active research.
And Sinclair mentions a paper by Jarrow and Rudd, who tried to work directly with the probability distribution of the asset price,
Yeah,
rather than just assuming that it's log normal.
yeah. But one of the problems with those types of approaches is that the skewness and kurtosis of the return distribution might not be constant across different option maturities.
So it gets pretty complicated.
Yeah.
Now, the book also talks about how implied volatility can be used to actually estimate the market's implied skewness and kurtosis.
Yeah, and this is done by trying to find the values of skewness and kurtosis that minimize the difference between the market prices of options and the theoretical prices that you would get from a model that incorporates those higher moments.
Okay, so you're kind of reverse engineering the market's expectations.
Yeah, that's right. And it's a pretty powerful technique.
Now, the book also discusses how implied volatilities for options with different expiration dates relate to each other.
Right. That's called the term structure of implied volatility.
And Sinclair mentions this phenomenon where the back-month volatilities, the volatilities for options that expire further out in time, tend to overreact to movements in the front-month volatilities.
Yeah. You would think that a change in near-term volatility would lead to a proportionally smaller change in longer-term volatility because of mean reversion.
Right?
But what actually happens is that the back-month volatilities often move more than you would expect.
So it's like they're overreacting to the short-term news.
Yeah, and it's a puzzle that researchers are still trying to understand.
Okay, so we've covered a lot of ground on implied volatility. Now let's move on to hedging.
Okay.
Why is effective hedging so important for volatility traders?
Well, the goal of a volatility trader is to isolate and trade the volatility itself. And that means that you want to minimize your exposure to the directional movements of the underlying asset.
Right.
So if you're long volatility, you don't want to lose money if the underlying price goes down. And if you're short volatility, you don't want to lose money if the underlying price goes up.
So hedging is a way to kind of neutralize that directional risk.
Yeah, it's like taking out an insurance policy. You're paying a premium to protect yourself from the risk of a big move in the underlying price.
And the book starts this section by introducing the concepts of utility theory and risk aversion. What are those?
Utility theory is a way of modeling how people make decisions under uncertainty. And it's based on the idea that people try to maximize their expected utility, which is a function that reflects their preferences for different outcomes. So, for example, most people prefer more money to less money. But they also become increasingly averse to losing money as the magnitude of the loss increases.
So a $100 loss hurts.